If you don't have a 401k available to you at your workplace, how do you save up for retirement? I've got some helpful ways coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so in my normal trolling, my normal work day, I'm looking at markets and looking at articles, that sort of stuff, and one stood out to me. Hey, if you don't have a 401k, what are your options? How do you save up for retirement? And it was clickbait to me. I thought, okay, well, let's see what this author says. And I click on it, and author is spot on. I mean, check this out. Spot on. Take a look at this article. We're going to hit some of the highlights here in just a second. But do you have a 401k available to you at your workplace? If so, I hope you do. I hope you're using it, okay? It's likely your greatest wealth building tool. Now, if you own a business or you've got some unique, you can throw a football 100 yards or kick through an upright from 60 yards out. You've got a unique talent, fine. That talent might be your greatest wealth building tool. But for most of us, from that human capital, making income, saving it, likely the 401k is your greatest wealth building tool. But what if you don't have one? Does that mean you're kind of sunk? How do you save up for retirement? Well, the good news is you've got some good options, okay? You don't need to have a 401k in order to have a successful retirement or to save up the right amount for retirement. So let's get into those options. I mean, to me, number one, and the article didn't mention this, but if you're married, if you don't have a 401k available to you and you're married, the very first thing you need to look at is, well, does your spouse have a 401k available to them? Okay, because say for example, if you and your spouse are each making $75,000 and for your financial plan, you've run the numbers and you guys need to contribute 10% each, great. Just do 20% to your spouse's 401k. Done. Okay? The reason why I would tell you that is you've got to evaluate. If you don't have a 401k available to you, and we've done videos on this before, you've got to evaluate what's the next best tax shelter in order to contribute to. Okay? The very first thing that you've got to figure out is what's your tax shelter strategy? Which tax shelters are available to you? And the ones that make the most sense, you've got to use those before you use anything that's not a tax shelter. So if you're married and your spouse has a 401k, 403b, some sort of workplace retirement plan, see if your contributions, because you don't have a 401k plan, can just go into theirs. We see this a lot with folks that are married where one of them is considered top heavy, okay, where they are highly compensated and so they can't contribute as much as they normally want to or need to or should into their own retirement plan. It's restricted. They can only contribute 2% above the average contribution of all employers all employees at their workplace. So instead, they contribute more to their spouse's 401k. So that's the first thing that I'd consider. Next, you're going to consider, again, going down the line of what tax shelters are available to you, Roth IRA or IRA. Okay, depending on your income, and I just did a few videos about the unique features of the IRA. You've got to have earned income, but you can't have too much total income. If you fall within the sweet spot, and most of us do, okay, then you're able to contribute to an IRA or a Roth IRA. If you don't have a 401k available to you at work, then it doesn't matter how much you make, you can contribute to an IRA and deduct it, okay? If you have a spouse and they've got a 401k available to them at work or some sort of workplace retirement plan, you might be limited in how much you can contribute or deduct to your IRA. So be aware of that. For a Roth IRA, as long as your total income is below a certain level based on your tax filing status, you can contribute. The maximum amount into the Roth or the IRA, they share the same contribution limit, is $6,000 for the year. If you're experienced in life, that's age 50 or older, you can do an extra $1,000, so that's $7,000 for the year, okay? So look at the amount that you want to be saving or need to be saving for your retirement. And if it's hopefully it's 15%, if you don't have a 401k available to you, that's fine. Calculate, well, what's 15% of my income? Okay, is that enough? Can I contribute to the Roth IRA or my IRA and get all of that funded? Okay, you've got to consider that next. Third thing I consider is, are you eligible to contribute to a health savings account? Do you have a qualifying high deductible health plan? If you do, fantastic, you can fund an HSA and therefore you can make a decision, well, Well, let's use my HSA. Let's convert my HSA, and I'm using that in layman terms. Let's convert my HSA instead of a health spending account. Have it a retirement savings, okay? A health savings account, you can either put the money in and spend it on medical expenses right away, or you can put the money in there and save it, invest it. Don't touch it. When you have medical expenses, pay those out of your pocket and keep the receipt. The HSA can then be treated like a retirement savings tool because you can invest it however you want to. It can grow, it will grow tax deferred. Yes, goes ups and down with the investments you choose, but it can grow, it will grow tax sheltered. And then when you draw the money out in retirement, if you're drawing it out for medical expenses, comes out tax free. That's even better than the 401k. If you're drawing it out to reimburse yourself for medical expenses that you already incurred while you had an HSA plan or a high deductible health plan, great, you can reimburse yourself tax free. Or once you turn age 65, if you don't have those medical expenses, which you likely will, but once you turn age 65, you can pull that money out and just treat it like an IRA. You pay tax, but there's no penalty on it once you turn age 65. So guys, if you don't have a 401k available to you, consider treating your HSA like a retirement savings account. Even if you do have a 401k available to you, more and more of you should be looking at your HSA as a retirement account. I am, and work with your CFP, see if that makes sense for you as well. So with any time you're saving up for retirement, you've got to have a tax shelter strategy. You've got to look at all the tax shelters available to you and have a strategy for funding the right ones. If you don't have a 401k available to you, that's okay. Look at your other tax shelters, Roth IRA, HSA, right? And then if you don't have any other tax shelters, then the last thing that you can do, and this article mentions it as well, is just open up a regular individual account or joint account. It's called a brokerage account, but yeah, that's jargon. Just go to Vanguard, go to Fidelity, talk to your certified financial planner, open up just a regular account and be funding the right amount for your retirement into that. Why would I put that at the bottom of the list? Because there's no tax shelter. There's no tax shelter. Your contributions that go in, there's no tax benefit. All of the interest and dividends and capital gains that are kicked off of those investments, yeah, you got to pay tax on. Anytime you sell an investment, buy something else, you've got to claim those capital gains, okay? So there's no tax sheltering. Therefore, I'd consider tax shelters before that. But if that's your only option, or that's your option where you can save up the right amount, that's okay. It's not the end of the world. Still, it's your retirement. You can save up and have a successful retirement even if you don't have a 401k available to you. Work with your CFP on that. See which option makes the most sense. Create a financial plan that makes sense from a cash flow standpoint, retirement planning standpoint, tax planning standpoint, investment standpoint. You've got to look at all 6 areas. And oh, by the way, my goodness, an estate planning standpoint. Oftentimes, if you're using a different type of account to save up for retirement, it's often overlooked who your beneficiaries should be and how that should transition to them. So you got to take a comprehensive approach, as I always say. So work with your CFP, see what makes the most sense for you. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.